The 3 stars in the north is recognized as a bearish reversal pattern found in financial market charts. This pattern is indicative of a potential shift from a bullish or ascending market trend to a bearish or descending trend. It is characterized by 3 consecutive bearish candles following an uptrend, symbolizing the gradual weakening of buying momentum and suggesting that sellers are beginning to dominate. In navigating the financial cosmos, understanding patterns like 3 stars in the north equips investors with the capability to anticipate market movements and make more informed decisions. The ability to identify such patterns and interpret their implications allows investors to strategize their entries and exits in the market more effectively, potentially safeguarding their investments against unexpected downturns and capitalizing on opportunities to profit. This knowledge forms a part of the toolkit for traversing the complexities of financial markets, emphasizing the importance of informed analysis and strategic planning in investing. The tri-star pattern is an intriguing configuration observed in the stock market, signaling a potential reversal of the current trend. This pattern is characterized by a trio of doji candles, which are distinct candlestick markers that show a level of indecision in the market. Each of these dojis appears in succession over 3 trading sessions, making the tri-star pattern a rare sight. The appearance of dojis, where the opening and closing prices are virtually identical, points to equilibrium between buyers and sellers, suggesting that a change in market sentiment may be imminent. The first doji in a tri-star setup indicates a pause in the prevailing trend, where neither bulls nor bears manage to gain a decisive advantage. The second doji reinforces this indecision, further solidifying the state of balance. By the time the third doji appears, it becomes apparent that the ongoing trend may lack the momentum to continue, setting the stage for a potential reversal. Identifying the tri-star pattern requires careful observation, as its occurrence is not frequent. Its rarity, however, underscores its significance, alerting astute traders and investors to prepare for a shift in market direction. When a tri-star pattern forms after a prolonged uptrend, it may signal a downward turn, whereas if it appears following a downtrend, an upward reversal could be on the horizon. Given the potential implications of the tri-star pattern, it becomes a valuable tool in the arsenal of those who are adept at reading market signals. Yet, like all technical indicators, it is important to integrate the tri-star discovery with broader analysis and market context to make informed investment decisions. Identifying the tri-star pattern involves recognizing 3 specific candlestick formations on a financial chart. This pattern is considered rare and signals a potential reversal in market trends. It appears during a period of consolidation within the market, indicated by 3 small candlesticks that emerge consecutively. To begin, the first candlestick of the tri-star pattern is characterized by a small body, indicating a tight price range between the opening and closing prices for that session. This is followed by a second candlestick, which should gap away from the first, also displaying a small body. The direction of the gap, whether up or down, is critical to understanding the potential market reversal. The third and final candlestick mirrors the first, presenting a small body that gaps back towards the initial candlestick, completing the pattern. These 3 consecutive candlesticks with small bodies and gaps between them create a visual cue for analysts. The appearance of this pattern suggests a pause in the current trend, hinting at a potential reversal. Investors and analysts pay close attention to the tri-star pattern as it provides valuable insight into upcoming market movements, allowing for strategic planning around buying or selling positions. The tri-star pattern is a notable formation in technical analysis that indicates a potential reversal in the market trend. It is considered a rare pattern and is composed of 3 candlesticks. These candlesticks are unique because all 3 appear as doji, which are candles that open and close at nearly the same price level, suggesting indecision among traders. When we delve into market sentiment and its connection to the tri-star pattern, it's essential to understand that this pattern captures a moment of equilibrium where neither buyers nor sellers have clear control, leading to a pause in the prevailing trend. Each doji in the tri-star setup represents a day of uncertainty, with the positioning of these doji being crucial to interpreting the signal. For a bullish reversal, the tri-star pattern appears at the end of a downtrend and signifies that the selling pressure is exhausting, potentially paving the way for buyers to take control. Conversely, a bearish reversal tri-star pattern forms after an uptrend, hinting that buying momentum could be waning and sellers might be poised to take over. The appearance of the tri-star pattern is a cue for traders and analysts to pay closer attention to other indicators and the market context to confirm the potential reversal. Due to its rarity and the ambiguity that comes with doji formations, this pattern should not be used in isolation for making trading decisions. Instead, it should contribute to a broader analysis framework where it complements other technical, fundamental, and sentiment indicators to offer a more nuanced view of market dynamics. The tri-star pattern, in the context of technical analysis, is identified as a rare configuration that signals a potential reversal in the market trend. This pattern is classified based on its appearance within a price chart and typically comprises 3 consecutive doji candles. A doji candle occurs when a financial instrument's opening and closing prices are nearly the same, resulting in a candlestick that appears as a cross or plus sign. These 3 dojis signify a period of indecision among traders, suggesting that the existing trend could be losing momentum. Classification of the tri-star pattern depends on its position relative to the prevailing market trend. If this formation appears at the peak of an uptrend, it is considered a bearish tri-star, indicating a potential shift to a downtrend. Conversely, when the tri-star is observed at the bottom of a downtrend, it is referred to as a bullish tri-star, hinting at a forthcoming uptrend. The emergence of a tri-star pattern triggers a watchful analysis due to its infrequency and the significant reversal signal it potentially carries. Traders and analysts pay close attention to subsequent price action following this pattern to confirm the anticipated reversal, often looking for additional confirmatory indicators to strengthen the predictive value of the tri-star pattern within their trading strategy. The tri-star pattern is a rare configuration that technical analysts pay close attention to due to its potential indication of a reversal in the current market trend. Understanding this pattern requires a focus on 3 key sessions of trading activity, where each session's open and close are near each other, creating the appearance of 3 stars. This pattern can signal a reversal, but confirmation is crucial before considering it a reliable indicator. Key factors for confirmation of the tri-star pattern include 1. Market context. The pattern is more reliable when it appears in a market that is either overbought or oversold. This context sets the stage for a potential reversal. 2. Volume analysis. An examination of trading volume can provide additional confirmation. For a reversal to occur, one would expect to see a decrease in volume on the third star, suggesting a weakening of the current trend. 3. Subsequent price movement. Following the appearance of the tri-star pattern, the immediate price action is critical. A clear shift away from the recent trend within the next few trading sessions provides further evidence that a reversal might be underway. 4. Support and resistance levels. The pattern's position relative to key support and resistance levels can also act as a confirmation signal. If the tri-star pattern forms near these critical points, it may indicate that the market is preparing to change direction. In summary, while the tri-star pattern is a rare find, its potential to signal a market reversal makes it a valuable tool for investors. However, seeking confirmation through additional market analysis and indicators is essential to increase confidence in the pattern's predictive power. The tri-star pattern is an unusual formation in technical analysis that signals a potential reversal in the market trend. It comprises 3 candlesticks, each representing a trading session's opening, closing, highest, and lowest prices. This pattern emerges in a scenario where 3 consecutive doji candles appear. A doji candle occurs when the opening and closing prices for a period are very close, reflecting uncertainty among traders. When we explore the reliability and limitations of the tri-star pattern, it is crucial to understand that, like any technical indicator, its predictive power is not absolute. The reliability of this pattern hinges on the context in which it appears, including the prevailing market conditions and volume traded during the appearance of the pattern. High volume periods tend to augment the pattern's reliability as they indicate strong participation in the price formation process. One limitation of the tri-star pattern is its rarity. Given its unique requirements, 3 consecutive doji candles, it does not occur frequently. This scarcity means traders and analysts might only seldom have the opportunity to act on this pattern. Additionally, false signals can occur. While the pattern strongly suggests a potential reversal, external factors such as economic announcements or shifts in market sentiment can override the pattern's predictive capabilities. In summary, while the tri-star pattern can be a compelling indicator of potential market reversals, its effectiveness is influenced by several factors including volume, market context, and its inherent rarity. Traders should use it in conjunction with other analyses and indicators to make more informed decisions. The tri-star pattern is a unique formation in technical analysis that signals a potential trend reversal. It consists of 3 doji candles, each representing a day of trading where the opening and closing prices are virtually equal. This pattern emerges in a market that is characterized by uncertainty and indecision among traders. When it appears, it signals that the current trend may be losing momentum and that a reversal is on the horizon. In terms of its synergy with other analysis tools, the tri-star pattern can be significantly more effective when combined with other indicators. For instance, using volume indicators alongside the tri-star can help confirm the strength of the potential reversal. A noticeable increase in trading volume on the days following the tri-star formation can indicate a strong agreement among traders about the change in market direction. Moreover, combining the tri-star pattern with moving averages can also provide deeper insights. For example, if the tri-star pattern forms and the price is near a significant moving average but fails to break through, it could reinforce the likelihood of a reversal. Similarly, oscillators like the Relative Strength Index, RSI, or the Stochastic Oscillator can help identify overbought or oversold conditions. If the tri-star pattern forms while the market is in either of these conditions, it could suggest a stronger validity of the reversal signal. However, it is important for traders to exercise caution and conduct a thorough analysis before making investment decisions based on this pattern. Like all technical analysis tools, the tri-star pattern is not infallible and should be used in conjunction with other indicators to validate trading signals. The tri-star pattern is considered a rare signal in technical analyses that hints at a potential reversal in the market direction. This pattern is formed by 3 doji candles that appear in close succession. A doji candle occurs when the opening and closing prices are virtually equal for a given time period, reflecting indecision among traders about the market's direction. In discussing common mistakes and misinterpretations when dealing with the tri-star pattern, it is important to emphasize the following points. Firstly, it is crucial not to jump to conclusions based solely on the appearance of this pattern. Due diligence in confirming the reversal with additional indicators or market conditions is necessary because the tri-star pattern alone does not guarantee a reversal. The market's context and other technical factors should align with the pattern to increase its reliability. Secondly, the rarity of the tri-star pattern means that some traders might be quick to label any 3 dojis as a tri-star without considering the nuances. The spacing and positioning of the dojis in relation to each other and to the surrounding candles are essential. Typically, there should be a clear gap between each doji, and the overall pattern should significantly stand out from the price action leading up to it. Lastly, it is a common mistake to overlook volume in the analysis. Volume plays a key role in confirming the strength of any reversal signal, including the tri-star pattern. Ideally, there should be a noticeable change in volume around the time the pattern forms, which can lend credence to the potential for a reversal. Understanding these common mistakes and misinterpretations is crucial for technical analysts and traders to make more informed decisions when encountering the tri-star pattern. By combining this pattern with other analysis tools and considering the market context, traders can better discern its implications and act accordingly. The tri-star pattern is considered an uncommon occurrence in the financial markets that signals a potential reversal might be on the horizon. This pattern comprises 3 doji candles appearing in close succession. In the realm of candlestick charting, a doji candle is recognized by its short body, indicating that the opening and closing prices are virtually identical or very close. The presence of 3 doji candles in a row serves as a visual cue that the market is in a state of indecision, suggesting that a change in the direction of the market could be imminent. When setting entry and exit points based on the tri-star pattern, it is crucial to approach this task with a strategic mindset. The pattern itself does not dictate specific price levels for entry and exit, but rather signals the potential for a market turnaround. Traders often look for confirmation in the form of a subsequent candle moving beyond the range of the tri-star pattern to validate the reversal signal. For entry points, a common approach is to wait for a candle to close beyond the high or low of the last doji in the tri-star formation, depending on whether a bullish or bearish reversal is anticipated. Exit points, on the other hand, are usually established by identifying support or resistance levels near the pattern, or by setting a profit target based on historical price movements. Understanding the tri-star pattern and how to set entry and exit points requires not just a familiarity with candlestick charting, but also a nuanced appreciation of market psychology and dynamics. As markets move based on the collective actions and sentiments of traders, recognizing patterns like the tri-star can provide insightful clues into impending shifts, allowing traders to make more informed decisions about when to enter and exit trades. It is always recommended to use these patterns in conjunction with other analysis tools and indicators to enhance the accuracy and reliability of trading signals. The tri-star pattern is known for its potential to signal a reversal in the market. This pattern is relatively rare and involves 3 consecutive doji candles. Dojis are candles where the opening and closing prices are very close to each other, indicating indecision among traders. The tri-star pattern's rarity and the specific setup of doji candles make it a signal worth noting for those analyzing chart patterns. When considering variations and similar patterns, it's important to understand that although the tri-star pattern is unique due to its structure of 3 dojis, other patterns may also indicate market reversal, but with different candle formations. For example, the morning star and evening star patterns, which consist of 3 candles but involve more significant price gaps between the opening and closing of the first and third candles compared to the middle candle, can similarly signal reversals. Additionally, the hammer and the inverted hammer, single candle patterns with small bodies and long wicks, point to potential reversals but are not as complex as the tri-star. Understanding these variations is crucial because it enables traders and analysts to recognize the broader context of market sentiment and potential shifts, even if the exact pattern of the tri-star does not appear. Awareness of similar patterns enriches the analytical toolkit available for interpreting market movements and making informed trading decisions. By comparing the tri-star pattern with its variations and similar patterns, traders can gain insights into the strength, timing, and potential confirmation of reversal signals in various market conditions.